here I'm joined by Joseph Tanious. He's the Vice President and Market Strategist at JP Morgan Asset Management. Dominic also joining us in on the conversation. And would you agree that this rally we're seeing this morning is justified?
It is justified. I think, so long as it appears that the situation in Europe is at least contained for the time being, I think this market does have some legs.
And you're saying valuations are also compelling right now. We talk all the time about how this past year's earnings, the S&P is only trading at about 13 times those earnings. They're trading even cheaper if you look at some forward-looking indicators. Is valuation a reason to be in this market right now? Is it the reason why all that money is going to start coming off the sidelines here?
Well, I think if you are, in fact, a long-term investor and you believe in this reversion to the mean idea, when you take a look at forward PE ratios right now at about 11.5 or 12 times earnings, whereas the long-term average over the past 20 years or so is roughly 16 times, you have to realize that a lot of these headwinds which have been holding down the markets, we are beginning to see a little bit of clarity as it relates to the pace of economic growth here in the U.S. We had some great numbers this morning, or encouraging numbers this morning. And again, the better than expected package that came out of Europe last night, all of these things I think are supportive and constructive for risk assets.
So does that mean that financials, for instance, which are the worst performers so far this year, are ready to break out of that then?
I think financials, I'm still a little bit cautious. There you are looking at a high beta play. So if you do in fact believe that the market's going to rally, financials, it is a bit of a risky move, but you can certainly go into that. When I look at some of the headwinds that financials are facing, and all this regulation and all the interpretation that still needs to go in this regulation, I'm a little bit cautious.
But how can you have a sustained rally, though, without a leadership in financials, though?
Well, I think financials are going to sort of, move along with the general markets. I just don't know that I'd necessarily take an overweight position in that market specifically.
Well, Betty, one of the things that we talked about just this past 5 minutes was this idea that some of the best performing sectors since the October 4th low have been cyclical. Yeah. They've been number one, energy up 18%. Number two, materials up 15%, but financials are number three, up 13%. So It could be, but what exactly is the play then? Have all these cyclical, economically sensitive plays kind of run out of steam, or do they keep going higher?
No, I think they keep going higher here. Like, again, we got a little more clarity out of Europe. It appears that this issue is at least contained for now. Not done. We're not completely past this, but at least the issue is contained for now. I think this is an opportunity to begin moving into more cyclical sectors rather than defensive sectors and the high dividend playing stocks that we've been focusing on over the past few months.
So then would you be rotating out of defensive stocks, though?
I think given the valuations and how cheap cyclicals look, and again, some of the clarity that we've gotten out of Europe last night, I think this is an opportunity to start looking at things like technology, consumer discretionary, and industrials once again.
Okay, and where do you see the markets going until the end of the year then? I mean, can this rally be sustained, or are we going to see some sort of pullback after this earnings season?
From a technical standpoint, I can't tell you if there's going to be some type of a pullback. I would say you always want to expect some type of a pullback, but as a long-term investor, if I focus on some of the fundamental drivers out there, I realize that earnings are looking pretty good. We can talk about third quarter profits. Margins are continuing to rise. You've got about 17% year-over-year earnings growth. Revenues are also in fact growing. So I think that directionally the markets are in fact going to head up from here.
So allocation-wise, it's not all in for equities right now, obviously,
no,
right?
Certainly not. I think you need to be cautious, right? Again, the pace of economic growth this morning was encouraging. We are getting some better than expected news, but there are still some risks out there. Confidence, one, remains at incredibly depressed levels. Let's not forget that fear of a recession can become a self-fulfilling prophecy. And then second, this November 23rd deadline for the Super Committee, now that we've got some clarity out of Europe, I think the focus is going to shift there. That is certainly a bit of a concern of ours.
But when you say long-term investor, I think any long-term investor is going to look at this market today and say, but I'm waiting for that next pullback, though, because every time I get in, the market drops another 500 points.
All right, well, waiting for that pullback and trying to time the top or the bottom of the market, in our view, has never really been a winning strategy. What you want to do is take a long-term view and build your strategic allocation based on your objectives and your risk tolerance. From our standpoint right now, we are cautiously optimistic, but still encourage our clients to be a little bit cautious moving forward.
Okay, Joe, thank you.
Thank you.
Great to see you again, Joe Tanious.